Merci, Françoise. Thank you, Françoise. I am glad I get to present in English. Usually my French improves after a glass of wine or two, but that wasn't possible. We're delighted to be part of the relationship with Pembroke Asset Management. We have a very similar outlook in how we do our research, very much concentrating on bottom-up fundamental analysis. And the organizations of Canso and of Pembroke share many similarities in that at Canso we are a private firm. We're owned by the investment staff. So as Ian mentioned, at Pembroke, they eat our own cooking. At Canso, we invest alongside all of our investors. If you see a picture of that airplane, that's a picture of a Canso. You may be familiar with the aircraft. It was certainly not the fastest, not the prettiest airplane, but it had a reputation of being incredibly dependable in getting the job done. And in founding the firm, John Carswell, our president and chief investment officer, said if we can build an investment organization in the same guise and image as the Canso airplane, we're going to have some satisfied clients. Canso was founded in 1997, specifically focusing on bonds. So if you see that figure, we run $7.5 billion, and that is entirely in fixed income. And with a real specialty on that corporate sector, we also do run some funds, similar to the GBC Canadian Bond Fund, that does have a corporate exposure, but the vast majority of those assets is in that corporate debt specialty, which we're known for at Canso. I mentioned quickly that Canso is really based on our own fundamental bottom-up research, and that is quite different and unique in the corporate bond and corporate credit marketplace. Most investors in the past, when they're buying corporate bonds, have relied extensively and almost exclusively on the research provided by external credit rating agencies, S&P, DBRS, and Moody's Investor Services. And at Canso, our view is we have to do our own bottom-up research, we have to do our own research, and not relying on those rating agencies, and develop our own opinions and assessments of the individual bonds that we investigate, we research, and we purchase in the portfolios. The backbone of that are the colleagues you see on this slide here, our senior credit and investment team, that all have an experience in the private lending side. John Carswell, Mutual Life, he was also a partner at Talvest and Foyce and Gordon Payne before he branched out and founded and started Canso. Gail Muty ran the corporate banking credit training program at Bank of Montreal, experience in lending Bank of Montreal's balance sheet and their monies. Heather Mason-Wood, similar experience at Bank of Nova Scotia. And all of these individuals have experience in that credit research, in that private lending side of assessing the risks and structuring debt and investments that we invest in. Also, our senior credit team is backed by an additional grouping of analysts. We have, we think, one of the deepest and most extensive credit teams in the Canadian market, with 15 people that are involved in credit research. We think it's one of the deepest teams. Additional individuals as research analysts, and also a dedicated trading desk of three individuals at Canso. Now, after a little background on Canso, you see the title of this slide. If we look back in 2011, when I was standing up at this podium, I think consensus out there in the whole room and in the Canadian market was that this was the year that interest rates would rise. And if you see on that chart there, that red line shows the yield on the long Government of Canada bond. So the 30-year Government of Canada bond. That as you can see, it started the year at a yield of 3.6%, and where it ended the year at about 3.45%. It's traded up recently with some strength in the market. The yield is up to 2.45%. So a drop from 3.6 to 2.45% in yield. That means that individuals are willing to invest in a 30-year Government of Canada bond, locking their money away for 30 years at a yield of 2.45%. When inflation is running in the vicinity of, call it on average 3% if you look at the monthly announcements, the most recent announcement just a little bit below that, but that means a negative real yield on a 30-year bond. And that negative real yield isn't, frankly, supposed to happen even on money market and on short-term paper. And you see there that the euro debt crisis and risk off the latter part of the year was really characterized by investors removing risk from their portfolio and investing in what is viewed to be the most secure assets and the most secure investments, which are Government of Canada bonds. In the U.S., that was U.S. Treasuries, and it was very much a period of risk off. And the interesting thing from a corporate bond manager standpoint is if we take a good healthy step back from what's going on, when we look at the market out there and we look at the investment opportunities, the corporations and the bonds we invest in, for the most part, are in a far better and superior financial position than they were 12 months ago, 24 months ago, 36 months ago. However, it's a very different picture when you look at what investors view to be the risk-free assets, those issued by governments. Governments are in far more problematic financial positions than they've been in many, many years. Whereas from the corporate bond vantage point, we have the opportunity at Canso to invest in some tremendous bonds by companies that have very stable cash flows, good, strong balance sheets that have been improving, and it's a tremendous opportunity at Canso. Whenever we price a corporate bond and we evaluate that particular bond or that investment, we look at what we call the yield spread. And the yield spread is the additional return that you get over and above investing in the same term Government of Canada bond. So that red line shows from 1980, and you probably have trouble reading the numbers along the bottom, 1980 up until present, and shows on average the additional yield you get and the additional compensation you get by assuming that additional risk of investing in a corporate bond. And if you see where that line ends, that red line, we are at very much recessionary levels. We are collecting on average about 1.8% in additional yield by investing in corporate bonds over and above Government of Canada bonds. That represents tremendous value. You see that big spike there? That was the credit crisis, a short period, also another period of tremendous opportunity. And we would say, looking forward, the opportunities we have in our portfolios today are quite similar to those that we saw coming out of the credit crisis in 2008 and 2009. Some tremendous values that exist out there in corporate bonds. On the Canso side, whenever we buy a bond, in the in-depth research that we do, we look at that bond as a long-term holding period. Are we comfortable with the quality of that company, with the stability of the cash flows, with that balance sheet? Would we be comfortable in holding that bond to maturity? We look to hold all our bonds to maturity. However, occasionally opportunities come along and people are offering to almost pay us too much for those bonds. If that situation arises, we are entirely prepared to sell that bond and to move into something that represents better value. But we are very long-term, but with the view that we are opportunistic and we will take advantage of situations as they arrive. A couple of examples of some bonds that we like and opportunities we like in the portfolios today. You see there two bonds. They're long cable telco bonds, Rogers Communications, Shaw Communications. You see I've listed the spread there, so that's the yield on top of the Government of Canada bond. 3%, so 300 basis points in additional yield by investing in a long Rogers Communications bond. 3.9% in Shaw. All-in yield 5.5% and 6.4% versus that Government of Canada bond, same term, yielding 2.5%. So you see in that additional yield column in Rogers, we're picking up over twice the yield as a similar term Government of Canada bond. In Shaw Communications, 2.6 or just over 2.5%. There is some tremendous value and opportunity in these portfolios. These are companies that, in our investigation, in our view, very stable cash flows. Rogers Communications is not the company it was under the guidance of Ted Rogers a number of years ago. Very conservative, very stable cash flows. Actually upgraded 2 quarters ago in its credit rating from triple B to triple B high. These are 2 bonds we own in the portfolios. And it's interesting, there are really 2 views out there of potential situations that can unfold in the market going forward. It seems that sentiment is that we're in a low-growth environment for an extended period of time. And if that's the case, these two bonds, we're quite happy to sit back and collect those coupon payments, 5.5% and 6.5% in terms of yield. That's pretty good in an environment where there is very low growth and Government of Canada bonds are yielding 2.5%. Our view is, though, if we enter a recovery, and given all the stimulus that's been forced into the markets and put in the markets and remains in place, we're quite optimistic in that we do see a recovery occurring in North America and in Canada. And in that instance, what you see is the portfolio would benefit additionally from yield spread narrowing. Those yield spreads of 3% and 3.9%, which is the additional yield that investors require to entice them to invest in corporate bonds, would also narrow. And that would result in a very healthy pickup in capital gain in the portfolio, and something that we would see likely going forward. We like long cable and telcos. Showed you the yields relative to a Government of Canada bond. Another pocket of tremendous value we see in the market is in the maple bond market. Now, I think I've talked to this audience a number of times about maple bonds, and maple bonds are foreign issuers that issue in the Canadian market, and they issue in Canadian dollars. So as investors, these are bonds that we can buy with no currency risk. So we can do our research, we can understand the issue, we can understand the security package, we can understand the company. And if you take a look, I've put one of the Canadian banks up here, Bank of Nova Scotia, in a similar term bond, is yielding about 2%. And in comparison, Goldman Sachs, a maple issuer, issuing in Canadian dollars in the Canadian market, yielding about 5%. Morgan Stanley, another holding we have in the portfolio, yielding 6.3%. Lloyds and Royal Bank of Scotland, two UK banks that we follow very, very closely. Royal Bank of Scotland, in our view, well, it's 82% owned by the UK government, higher Tier 1 capital ratio than Royal Bank of Canada, at a yield of 5.7%. And in that risk-off trade and that risk-off theme, when investors are trying to remove that risk from their portfolio, they're very much shying away from bonds and issuers like this, and this is where we do our best work, and we find some of these opportunities. You see that bar on the right-hand side, yield in home market. You can see Goldman Sachs in the U.S. market is yielding 1.3, yielding 70 basis points less, 0.7 of 1% less, and a common theme across there. These represent tremendous value in the portfolio, and that all comes together and that culminates in the characteristics we have in the two portfolios we run for Pembroke today. Now, there's a lot of numbers on this chart, and I encourage you, if you have additional questions, my colleague and I are doing a breakout afterwards downstairs again. But if you look at the top headline there, the yield to maturity on the Pembroke Corporate Bond Fund is a very healthy 7.1%. So if we didn't trade any of the bonds in the portfolio and we just held that portfolio and allowed all the bonds to mature, we would have a yield and we'd have a return of 7.1% versus the overall DEX Universe Index and DEX Corporate Index at 3.2 and 2.3%. In the GBC Canadian Bond Fund, that yield to maturity is 4%. And you see a couple of other characteristics. The Pembroke Corporate Bond Fund, we have almost half of the portfolio invested in maple bonds. We're able to get very, very high-quality bonds at far higher yields than domestic issuers. And you can see as well there in the bottom floating rate notes, which we also like because we do eventually see with long Government of Canada bonds yielding 2.5%. Eventually those yields have to rise across the board and a more normalization of that yield curve. And in that environment, those floating rate notes, which will adjust in the event of rising rates, will prove very positive and defensive in that portfolio. So a quick summary, our outlook. Going forward, we do think and believe very strongly that interest rates, the yield curve will have to normalize, that interest rates will have to grind higher. In that environment, floating rate notes, which are very cheap right now and offer tremendous yields, will also be very defensive in that environment. Corporate yield spreads, really in two environments, will narrow. In an improving economic environment, when people are more comfortable in assuming more risk in the portfolio, that will narrow in that spread quite dramatically. And frankly, you could also paint the picture. Government of Canada bond yields at 2.5%. In the long side, a communications bond like Rogers or Shaw yielding 6.5%, that in itself is going to start to look pretty attractive. And as well, through security selection, and that's the research capability we have at Canso, Maple Financials represent, and Maple Bonds in general represent tremendous value, and that's where we see a lot of opportunity in the portfolio going forward. I did go through that quite quickly. I'd encourage you, if you have any other more detailed questions on Canso or some of the things I talked about today, my colleague and I will be available at the breakout afterwards. We very much appreciate the faith you put in us at Canso. We take that very seriously in the research we do and assembling the portfolios we manage. Thank you very much.